The very first thing that we want to talk about, and this is really the Magellan Global Trust and the Magellan Global Equities Fund, so the two listed funds that we have. The Magellan Global Equities Fund is the same as Magellan Global Fund, which is our big unlisted fund. What we're trying to do is two things. We're trying to generate returns, attractive returns. We've actually set ourselves a benchmark at 9% per annum net of all fees over the longer term, and we want to minimise the downside risk that we have in the strategy. Of course, we've been in a bull market for a long period of time, and people may forget the downside side of the equation. So how have we done over just over a decade? What we've done is we've sort of set out our yearly 1 year, 2 year, 3 year, 4 year, 5 year, all the way through to 10 years. We're actually up to 10.5 years. It'll be 11 years in this end of June. And you can see, have we achieved the 9% per annum over time? And you can see there's one red cross. We apologise, over the last 3 years, we've missed it by 20 basis points. And all I can say is this has smashed the markets over the time. So we're very, very focused over the long term over the investment objectives. Of course, we can have a year if the market's a negative 20. We're not saying each year we're going to do 9% per annum. What happens on average over time. The second one, and Andrew, I think you touched on this, is I think there is an issue of consistency. It's very easy for people to show statistics. You can show anything you like. So you can pick a 1 year period or an 18-month period. You can change the month from an October to November, and magically the numbers all change. A lot of people are doing that at the moment. So what we've said is over the last 10.5 years with a 3-year rolling basis. So because you can't choose when your clients come in, they can come in at any time. So a rolling return is the way to look at consistency. So we've looked over the last decade, and that gives you 93 observations, 93 months of 3-year periods. And versus our peer group, 91% of the time, we have outperformed the MSCI. The benchmark or the peer group we compete against has outperformed the benchmark 1/3 of the time. And we have delivered an average excess return over those 93 rolling months, 5.1% a year. And our peer group has added negative 0.1. And this is after all fees. And that Morningstar comment, when Morningstar look at us, the top quartile since we've launched 94% of the time. I think it's actually top 10 percentile or something, but quartiles will do over time. And we're not going to go through, but we've actually set out who we regard in Australia as the competitors who are competing against us. And you can see we're number 2 on consistency, 91% of the time. It drops away very rapidly. A lot of our competitors are not even outperforming the benchmark half of the time. So that means when your clients come in, your clients come in any month. So what type of experience are they going to get over the next 3 years? If they come in this month or next month or 3 months' time or 5 months' time, most of our competitors are down in the sort of 30% range of outperformance. And if you adjust the outperformance for excess returns, we've clearly got the highest excess return over the period. So we just wanted to put that on the table to say that consistency really matters. Don't get caught up what happened in the last 12 months or 6 months. Who are the people consistently deliver client expectations? And the last one, which is downside protection here, since we've launched the strategy, we've ended up getting a downside participation. So in a 3-month period where the markets have gone down, how much did our strategy go down compared to what the markets went down? So of every 3-month period over the 10.5-year period, we've captured 0.5 of the downside. And we've actually captured slightly less than 1 of the upside. So your clients are getting nearly all of the upside in the markets and getting about half of the downside in markets. If you look over the last year, which is on this chart on the right-hand side, we've got slightly over 1 participation, but there was no 3-month period where the markets went down. And as Warren Buffett says, we'll see who's swimming naked when the tide goes out. There are strategies who have delivered more excess return just in the last 12 months and beating the drums around that. But let's see what happens. If you look at their consistency over time, many of the funds who are outperforming at the moment are down in the 30% range in consistency over the long term. And their excess returns over the long term are almost zero, yet they've had a great year and 1 year periods. So what is the macro update, which is, and I'm pretty cautious at the moment. 2 weeks ago, we released a paper that some of you may have read or not read. So why am I cautious in our stance at the moment? First of all, I think we all have to accept that asset prices are at or near all-time record highs. And you could go through the whole credit spectrum and high yield spectrum. We still have a massive amount of sovereign debt in the world, particularly out of Europe and Japan, that is at negative yields. Equity markets have, after February, have rebounded at or very close to their all-time record prices. And at the same time, the Federal Reserve and the ECB have commenced programs to exit their ultra-loose monetary policy. Added to this exit from this, and this is this incredible period over the last 9 years. We've never seen a period of sort of quantitative easing. You'd have to go back to the 30s to get anything sort of comparable here. They're trying to exit these policies and engineer a soft landing, but just as they're trying to engineer this soft landing, the US Trump administration has thrown in a hand grenade of massive fiscal stimulus at the top of the cycle, which potentially makes the job a lot harder to get a very soft landing to occur here. We think where assets are priced and the fact that the central banks are moving, but we've got this synchronised global growth and we've got stimulus in the United States, the risks are asymmetrical to the downside. And if we saw a very meaningful jump in longer-term bond yields, let's say above 4%, they're about 2.9% at the moment, but if they went above 4% and that happened relatively rapidly, it's not inconceivable to see a very large asset price correction occurring. Whether or not this happens or not, you know, we've had an absence of inflation in the world. We've had this Goldilocks period where we've had very long periods of sort of economic growth, not incredibly fast, but no inflation in the world. If that continues, I think we can all relax. But if it doesn't, I think we have to think of what's ahead of us. This chart, I think I showed you last time I was presenting to you about how we think long-term interest rates are going to play out. Of course, before the financial crisis, long-term rates were around 5%. After the financial crisis, the central banks suppressed, through quantitative easing in the world, long-term interest rates. And they actually hit a bottom of about 1.4% in the United States. In Europe and Japan, they took them to effectively zero levels. As you extended this period of super low interest rates, it actually inflated asset prices around the world. We've all been beneficiaries of that. But the next period is this reflation and the exiting of quantitative easing. How high will they go? Will they go to 4+? Will they go to 5? Will they stay at 3.5? That is the question that all of us don't know at the moment. And that is the risk in markets, of just how high that next cycle's going. We think if you took a very long-term view, maybe not over the next 3 years, but you took a view out a decade, we think some of these large secular forces at play that have been keeping inflation low are going to prevail in the very long term. I think we are going to see massive technological changes. It's going to lead to huge productivity gains in the world. I think we've got the Amazon effects in terms of retail prices that can occur in the world. We've got demographics aging. We've got demand for long-term fixed income as the demographics play themselves out. So in the long term, I think rates may well be at 2 or 3% in the long term. But what matters to investors, what happens in the next 1 to 3 years, is what's critically important here. So just to put the central bank activity in context, if you went back a decade, the central banks weren't buying any assets. In the last few years, the ECB and the Bank of Japan has been buying assets at the rate of $1.5 trillion a year. That is a massive change in the supply-demand curve. They've been pushing investors out of those sovereign bonds and other corporate bonds they've been buying and forcing them to buy other assets. When they're buying, they're pushing the prices of those assets up, and that money has to find a home somewhere else. But what's going to happen over the next few years? From that $1.5 trillion, the US Federal Reserve has already said that they have commenced a program last October of shrinking their balance sheet at $10 billion a month. And over a 12-month period, they're going to take that up to $50 billion a month in an automatic program. That adds up to $600 billion a year. So that's going to take the level of support from $1.5 trillion as at October last year over a 12-month period down by $600 million a year to $900 million a year. The ECB has also announced a program that they halve their rate of asset purchases from 60 billion euros a month to 30 billion euros a month, and have just changed language. They said they're going to do it till September, but they've changed language that's providing a very strong hint that maybe that 30 will go down to zero. If that happens by the end of this year, the central banks will effectively taken out $1.5 trillion of supported buying assets in the world. And you only had to go to your first economics lecture to know when you shift the supply and demand curve, you can actually get a change in price. So that's the first thing we have to be mindful of. The second one is with these tax cuts and also the deal that was done between the Democrats and the Republicans to effectively extend the debt ceiling in the United States, actually added additional expenditure into the economy for the next two years. We're now at the end of a very long economic growth period in the United States. Back before in 1997-98, they were actually running a budget surplus near the top of the last economic cycle. Actually, the top of the last one was obviously 06-07. They were running budget deficits of 1% to 2% of GDP. We're now at the period we're going back to budget deficits around 5% of GDP. You'd normally expect that to happen when we have an economic downturn. It is very, very unusual that governments increase their budget deficits at the top of a cycle. So that's adding a potential cocktail here. And if you look at the economy and you look at unemployment here, we're at near all-time record lows. We just printed over 300,000 jobs in February. They upgraded the jobs growth from January. Even if you look at the broader measures of unemployment, which is called U6, partly employed people, partly attached people, we're at pre-GFC levels. So we're at very low levels of unemployment now in America, adding stimulus at the moment. The big risk here is that wages inflation accelerates. That is a big unknown. Obviously, the 2nd of February, when we got the January numbers, the market had a heart attack. And then when they released the figures this week, everyone was relaxed and the markets went up because wages growth looked like it had come back a little bit, as in we have a Goldilocks moment again. We can keep growing, keep adding jobs and have no inflation. We're saying over the next 12 months, there is a reasonable probability if we keep going with the stimulus we've got in that we could actually have wages inflation. And if the Federal Reserve gets caught behind the 8 ball here, we could be in for some real volatility. And I think what happened on the 2nd and 3rd of February was a taste of what may be in store if this happens. I think it's a 50-50. That's another way of saying I don't know, but it sounds sort of more convincing if I say 50-50. Is this material? If you think of equities as a very long-dated bond, so we're just saying that if you say long-date 30-year treasuries yield 3% at the moment, which they do, if you move that yield to 4% of those treasuries at the moment, or the discount rate, you'd lose about 17% of the value, and at 4.5%, you'd be off 25%. So shifting from a 3% world into a 4 to 5% world is material for asset prices. Is all we're just trying to give people the feeling that this is a big issue for people to get their minds around. So the question is, how are we positioning ourselves at the moment? Many people have heard Magellan and probably myself prattle on about technology a little bit. I think there's two big issues in technology at the moment that you need to think about. First of all, we've got the emergence of these massive platform companies that are hugely disruptive, and it's because of the cloud, it's because of AI on these platforms, and because massive network effects that happen as you get more users attached to the platforms and more data, you're getting winner takes all in most markets. So what have we done? We've rotated our portfolio. We'll show you we're about 40% in technology. It's actually quite diversified with some very, very interesting plays there. And the other side of this is, as these platform companies move in on more industries, more traditional industries are going to get disrupted. So you really need to think about, where do we want to place in traditional industries? You know, retailing and media was an obvious area which is getting deeply disrupted. We would argue consumer staples are starting to get disrupted. Consumer staples has been a stalwart of people's portfolios over the last decade. Actually, over the last 20 years have been an incredibly good place to have your money. We question whether they're going to be incredibly good places to have your money in the future. And if you look at our portfolio 5 years ago, 38% of our portfolio was in retailing and consumer staples. And we made a lot of money over time having those positions. And we had 25% of the portfolio in technology and only 3% in cash, as in 5 years ago, we weren't very worried about what was going on in the world. Today, we have 12% in cash. Actually, I released last week that we have now got 13.5% in cash in the Magellan Global Equities Fund. We're actually over 20% cash in the Magellan Global Trust. We're down to 12% of the portfolio in some retailers at consumer staples and 41% in technology related businesses now. So a big rotation from where we've been, but we would argue that the defensive characteristics of our portfolio remain about the same as they were. This is just the portfolio positioning between our two listed vehicles, the Magellan Global Equities Fund, which is the active ETF, effectively trades at NAV every single day. It's at 12% cash, 41% in technology. The Magellan Global Trust, which is the LIC, which you supported last year, that's in 22% in cash and 40% in technology. So it's big technology weighting. It's been more underweight consumer staples. It's actually been better positioned in the last 3 or 4 months in having more cash. It's actually outperformed the other strategy over that relatively short period. Let's not get too carried away. And I sit on both of them, so you know, Stefan's helping me obviously very much on the Magellan Global Trust. We're separating our worlds, not surprisingly, into technology winning platforms. You can see we've got some of the biggest consumer tech platforms: Apple, Facebook, Google, eBay. We've been long-term players in payments. Visa and MasterCard. 12 months or so ago, you would have seen PayPal also in the portfolio. We sold it purely on valuation grounds. Enterprise software businesses, Microsoft. We bought Microsoft when it was deeply out of favour at $28 a share, and everyone thought we'd lost our minds. It's now $94 a share. Who would have thought one of the largest market cap companies, it's the most researched companies in the world, would be one of the best performing stocks in the world since we bought it? It just shows markets can get it wrong. And then we're in a bunch of businesses that we think fundamentally have a low risk of disruption. You could think about quick service restaurant businesses. Yum Brands has been a stalwart. McDonald's. We've sold down recently a bit purely on valuation grounds. We think it's strategically very well advantaged, and we've recently taken a position in Starbucks that we think is slightly out of favour at the moment, but very well positioned in the long term, and has got a fabulous growth business in China. Insulated retails, Lowe's and Costco. Interesting, we own Tesco, but I don't have Tesco on this chart of low risk of disruption. It's kind of a deeper value play. I don't really like deep value plays. That's just a bit of a therapy stock for me. It's one I didn't really get right in the past. It's a very small position. Management team's fantastic, by the way, and we're a very difficult business. Hospitals, HCA, largest hospital operator in the United States of America. It's like Ramsay, trading 11 or 12 times earnings. Since we bought it, maybe 12 or 18 months ago, we're probably up 30% since we've bought it. It's been a very strong performer. Staples consolidation, the 3G play, the Brazilians and Buffett, these Kraft Heinz, the people who will consolidate the staples and household personal care industry of the world over time. Communications infrastructure, they own all the macro towers in the United States, or it's a duopoly between them and American tower company called Crown Castle. So some people say we're just a US tech fund. All I would say that I think our technology portfolio is quite unique. It's about 40% of our portfolio. If you look at the average earnings per share growth of this portfolio we hold, it's around 20% a year for the next 2 years. And if you look 2 years out, which in way of thinking is in 12 months' time, what is the 1 year forward price earnings multiple of this portfolio? It's 19 times. On a price to growth basis, this portfolio is not expensive. And I would argue things like Alphabet still have businesses in them that are massively loss-making inside this PE multiple, like their driverless car business, Waymo, So Alphabet's even cheaper if you start peeling the onion a bit. So this isn't going back to 2000 when we're buying things on 100, 200 times earnings or trying some multiple of sales analysis. If you look at relative to the growth profile, this is not a bubble. And actually, when you saw what happened in February, most of this complex didn't move as the world has shaken, because they're so advantaged. And we will sell things on valuation grounds. We've been selling down Microsoft over the period as it's been getting more expensive. When PayPal got to a price we no longer thought it was attractive, we sold it. So we will buy businesses purely on how we see the value relative to their quality and their growth opportunities that they have it. Our job is to make people money, and our second job is to not lose people money. We don't buy on a momentum basis. The other thing that people have said is that we're just a US fund, because very simplistically you could look at our portfolio and say 77% of the portfolio is US listed companies. The first thing we would say is the underlying earnings or revenue of our portfolio, 47% is in the United States. The MSCI by listing is 59% in the United States. So we're not a huge bet on the United States. We are slightly overweight because I'll show you what we have in our portfolio is we have some domestic businesses. We have a number of businesses in the UK, domiciled, and their businesses are in the UK. We have some businesses, 5 businesses that are purely what we call US companies, where their businesses are all in the United States, like HCA, I talked about, the hospital operator, trading on 11 times earnings. Wells Fargo, trading on 10 times earnings here. Lowe's, it's a duopoly, home improvement retailer, trading on 15 times earnings. So what we would say to you is our US portfolio is much cheaper than the markets are at the moment. So where we've chosen to be in the United States, the rest of our portfolio is in large multinational businesses. 9% of them are non-US listed multinationals, and 60% of our portfolio is in multinationals that are listed in the United States. That's why our portfolio looks so much like a US portfolio, but when you peel the onion of all those multinational businesses, they operate in over 190 countries. They have revenues from all around the world. 21% of their revenues are out of emerging markets. They operate everywhere. These are buying the world, and we would argue buying the very best companies in the world in their sectors. But at a headline basis, 60% of our portfolio is in US listed multinationals. It just happens the great multinationals of the world were largely formed in the United States, followed by Europe and Japan. But most of them by domicile are from the United States. You think of all the big tech multinationals outside, the multinationals outside are really something like SAP. The Chinese tech companies are domestic businesses. They're actually not multinational businesses. They're good businesses, by the way, but it's not a multinational play. It's a very China-centric play there. So I just want to overcome some of the observations maybe competitors make about Magellan that we're some US tech fund. It's just simply not true when you peel your onion. And we are investing in areas, as I say, barbelling between the winners and the non-disruptors of the world, plus taking a very conservative position at the moment, probably almost 14% in cash at the moment to protect people. If the next 12 months is going to be potentially quite difficult. I'm quite excited by it, by the way. We like it when things start to shake, and I think everyone here at Morgans knows we've got 3 listed options. The Global Trust, which is the actively currency managed LIC with the 4% dividend payout, and also that great DRP plan that you can opt in and get a 5% discount that Magellan Financial Group pays for. Magellan Global Equities Fund, which is obviously our core flagship global equity strategy, which is an active ETF, but it just pays out its earnings effectively each year. And then we've got a currency hedged version of that, MHG. So MGG, MGE and MHG that all Morgans will be familiar with.